4 years on from the financial crisis of 2008, banks are still making headlines for all the wrong reasons. Today it was the news that one of the world's biggest banks, HSBC, has allowed Mexican drug cartels to launder money through its accounts. That's on top of revelations in the last few weeks that JP Chase has lost billions in risky trades and Barclays has been manipulating interest rates. Regulators are trying to impose tougher standards, but the banks are resistant. North America correspondent Michael Brissenden reports.
It's now nearly 4 years since the financial crisis that began here on Wall Street ripped through the markets, sent the US into a recession and undermined the global financial system. And it's now just 2 years since Congress enacted a bill that was designed to prevent financial institutions from engaging in risky trades with the protection of knowing the taxpayers would be there to bail them out because they were simply too big to fail.
What we learned is that we need serious regulation, and what we've gotten is a lot less than serious regulation.
I think much of what Dodd-Frank has done is just gone in the wrong direction. In fact, I think much of what Dodd-Frank does would probably actually increase the severity, if not the frequency, of future financial crises rather than lessen them.
Dodd-Frank, as it's called, named after its co-sponsors, Senator Chris Dodd and Congressman Barney Frank, is a confusing collection of regulations over 800 pages long. Since its introduction, it's been diced, split and challenged so much that nearly 2/3 of the rules have yet to be finalised. Among the most important is the Volcker Rule, designed specifically to prevent what's called proprietary trading.
Seems simple enough to ban proprietary trading, but it turns out that the lobbyists for the banks are busy, and they've raised hundreds of questions. So, in fact, the regulations that would govern this law, this part of the law, have not yet been written.
And one of the busiest banks of all has been JP Chase, at least until a few weeks ago anyway. It's emerged that the bank's chief investment office had only recently lost billions in hedging activities and speculative trading.
They lost an enormous amount of money. In May, they announced that they had lost something like $2 billion. By now, they've told us we're up to $5.8 billion. They guess it could be as much as $7.5 billion. Outside people think it could be as much as $9 billion. I mean, we're talking real money here.
President Obama says the financial reforms do discourage banks and financial institutions from making risky bets. But no one seems confident that the new rules would have prevented the trades by JP that resulted in the recent losses. And it certainly left some wondering if Wall Street really has learnt the lessons of the crash of 2008. Until the losses surfaced, Jamie Dimon had the rarest of reputations on Wall Street. He was considered one of the most credible leaders in a discredited industry. His bank came through the financial crisis unscathed, and he'd been leading the charge against the Volcker Rule. But here, in a recent appearance before the Senate Banking Committee, even he seemed unsure how the rule would work.
I think you also said you didn't really know what the Volcker Rule is. Yeah. Boy, if you don't, we don't either. But I think you know how it's being drafted.
I think you're allowed to portfolio hedge under the current construction of Volcker. I think you should be allowed to. What it morphed into, I don't know what the current rule would do.
When Jamie Dimon can't manage the risk in his own bank, that tells you that other banks are in big trouble. We need better rules than the ones we have.
EILEEN APPELBAUM is an analyst with the left-leaning Centre for Economic Policy and Research. She's of the view that regulation is the way to rein in risky behaviour. It may not come as much of a surprise that across town at the right-wing Cato Institute, they see things a little differently.
The solution is to have less regulation and more market discipline, where Jamie Dimon is not answering to legislators or regulators. Jamie Dimon is answering to creditors.
Mark Calabria spent 6 years as a senior advisor to the Congressional Banking Committee. He's one of many who believes successive US governments have simply been kicking the can down the road. Let the market sort it out, he says, regardless of the short-term pain.
If you want good business practices to thrive, you need to stop bailing out bad business practices. Economies change, life changes. You need to have a fluid, flexible system that allows that change to occur in a way that's seamless. Now, of course, there'll always be pain when there's transitions. But again, there's more pain, in my opinion, by delaying the transitions than there are by allowing them to happen.
They might not agree on much with the suit wearers in the conservative think tanks in Washington, but many of the protesters who turned out to occupy Wall Street last year also oppose the idea that banks should be bailed out by the taxpayers.
We're alive. We just don't need to occupy a park anymore, because that was the first stage to get the media's attention.
This is all that's left of the Occupy Wall Street movement in Manhattan's Zuccotti Park, a lone information desk. But the anger and frustration over the perceived greed and power of the big banks is still a live political issue.
Well, I don't think we have any choice. I mean, what we ought to do is hold the guys who run the system totally responsible. Jail time is a very, very big deterrent.
But the scandals just keep coming. News that one of the world's biggest banks, HSBC, allowed Mexican drug lords to launder money through its US accounts and did business with firms linked to terrorism is just the latest. The biggest scandal is still unfolding.
The LIBOR crisis is at the moment the most, it's the biggest scandal and the most difficult problem now that we face in terms of the financial system.
When I read the emails from those traders, I got physically ill. It's reprehensible behavior, and if you're asking...
The LIBOR scandal, whereby banks colluded to fix the London interbank offered rate, the rate that fixes international money market rates, has already cost Barclays CEO Bob Diamond his job and his bank $450 million. Now, the US Justice Department is building a criminal case against Barclays and several other banks. At stake is $360 trillion worth of derivatives and interest rate default swaps, 300 trillion of them sold here in the US to hospitals, transport companies, non-profit organisations and to cities and local councils, many of whom are now going broke. The city of Baltimore is now leading a federal lawsuit against the banks that set the LIBOR.
The LIBOR scandal is a huge scandal, and it's global, and it's unclear just exactly. It's certainly going to cost the banks, the big banks, a lot of money, but it's unclear how it's going to end.
One thing it certainly won't do is help restore faith in what is clearly still a deeply flawed global financial system.
Michael Brissenden reporting.